Okay, good morning. Welcome to our rainy Tuesday. Today what we're going to be doing is we're going to be talking about Chapter 11, finishing up Chapter 11. Before we get there, just a reminder about what to do. Saturday, we're getting down to the end. We just have 4 classes left, including today. So Saturday, we have attendance quiz. Can you move the cursor on that one? Attendance quiz 24, Chapter 11, 12 homework. They are combined. We're finishing up Chapter 11 today. We might start on Chapter 12. We will certainly finish Chapter 12 on Thursday. Sunday, the last video quiz is due. So video quiz 25 over Chapter 13 is due. So we are coming down to the end here. And again, as promised, I'm going to go over final exam details every day until the final exam. Final exam is due by 6 p.m. on Thursday, May 8th. The final exam, by the way, you have a maximum of 120 minutes to take it, just like every other exam. I would say on average, that average student is going to take about an hour and 5 minutes, so there should be quote unquote plenty of time. It covers chapters 8 through 13, the content that we have been covering in class, not the learning objectives we've specifically excluded. I have taken those ones that we're not covering and taken them out of study plan, so you won't find them in there either. The final exam will be similar format and length as our other exams. And those present value tables that we did in Chapter 8 or 9, if you need them, they will be provided as a pop-up on the question, so you do not need to bring those with you to the final. I see a typo on my next slide. The final exam, just as a reminder, okay. I was originally going to add 10 points, and then I went and added 12. So final exam, there we go. Okay, there is the 12-point bonus opportunity on the final exam. To get the 12 points, you need to complete the final exam by 6 p.m. on Sunday, May 4th. To receive it, if you're registered with SAS, I sent you an email last week. That email would require a response by tomorrow, and that's stated in the email. So if that applies to you, you would have gotten an email. If you don't see the email, you need to contact me. And again, that's for a couple students with SAS. No exceptions. This is the only way you can get the 12 points added. The lab is open from 8 a.m. to 6 p.m. on Sunday, May 4th. I know there's several students who have already scheduled with ProctorU. If you're a ProctorU person, that is, they have limited appointments, so if you want to take it Sunday, schedule now. In the lab, obviously you don't need an appointment. You have to start the exam in the lab by 4 p.m. on Sunday. Brian and I are proctoring on Sunday, and there's some lab people there too. We have exclusive use of the lab pretty much from 8 a.m. to noon. There's approximately 72 computers available. So I would urge you, if that works in your day and in your schedule, to come Sunday morning, probably right at 8 a.m. There'll be a lot of people, and we'll get you signed in as fast as we can. And then it should be pretty steady throughout the day. And again, there won't be any other classes in there from 8 a.m. to noon, so that's good. But you do have from 8 a.m. to 6 p.m. There's just other classes that can take the exam on Sunday starting at noon. If you submit your exam even 1 minute after 6 p.m., you will not receive the 12-point bonus, so you need to be aware of that. In the lab, it's not a problem because you started at 4 p.m. If you have 120 minutes, it will be submitted automatically by 6 p.m. This is an issue if you're taking it with ProctorU, because ProctorU doesn't care when you start it. So if you submit at 6:01, you're not going to get that bonus. So be sure to allow yourself plenty of time to do that. And if you're not ready for the exam, don't take it Sunday. But I would encourage you to rearrange your studying and your schedule so that Sunday might be an option for you, because that 12 points is pretty big bonus there. Okay, with that, now Chapter 11 is about the income statement and statement of stockholders' equity. There's a hodgepodge in it. You watch the videos on by Sunday night. We had videos on Chapter 11 and Chapter 12. Last Thursday, we went over homework for Chapter 11. So what I want to do in the first part of today is I've got a lot of questions. And the nice thing about Chapter 11, it's primarily not computational. And I have a lot of, not a lot, a fair number of questions that are designed to point out some little nuances that are important but maybe aren't immediately obvious. So just as a reminder, the Chapter 11 learning objectives, we're only doing learning objectives 1, 4, and 6. So today we're going to do a whole bunch of questions, non-computational I believe for the most part. So we're going to start a lot of true-false, but these are great. So I'm going to be walking around polling people. I'm going to find out what's online for some of them. So first one, I'm going to do several, I think, true-false right in a row. Publicly traded companies have the option to produce audited financial statements. Is that true or false? So again, we'll go quiet while people write it down, and then I'll solicit for answers. If you're online, what the heck? Oh. That was me. I was squishing the, thank you. If you're online, ignore completely what you're seeing here. Yep. Yeah, let's, I was trying to do too many things at once. What I was going to say is I'm turning off the audio, and you can tell them online when I start talking. Okay, and we're back. What do you have online for answers? Okay, so we have a predominance of falses. And this is indeed false. And the reason it's false is because publicly traded companies don't have the option. They are required to. If you are a publicly traded company, you absolutely have to have audited financial statements. And that's part of the bedrock of our investing system. The fact that as an investor, I know that the company is having an independent third party look at their financial statements. If I didn't have that assurance, I would be worried that they're just making up numbers. Of course, having an audit doesn't guarantee that things are okay, but it makes it a lot more likely that things are okay. That's our first one. So very good on that one. Okay, next question. This is also another one that you have to think about carefully. The next one, true, false. Publicly traded companies, get there, will appear. Okay, publicly traded companies have to file their financial statements with the IRS. True or false? Again, my mic's off. Brian will tell you when I start with audio because I'm going to walk around and get answers on this one. I love this question. Okay, I'm back. Brian, what do you have? Okay, so it was about roughly the same. I think we had even bigger variance here. This question, the reason I love this question is it provides a good discussion point for the 2 or 3 people who said false. This is absolutely false. So you're surprised? Okay, so let's talk about why this is false. Okay, we have financial statements. Financial statements are a balance sheet, your income statement, your statement of stockholders' equity, your statement of cash flows. Those are audited, publicly audited, audited by your public accountant for all publicly held companies. Okay, so those are our financial statements. Those are prepared in accordance with generally accepted accounting principles or with international financial reporting standards. So those are your financial statements. On the other hand, what do you file with the IRS? You absolutely do not file financial statements. Financial statements are not filed with the IRS. The IRS has forms you fill out. You fill out an income tax form. It might be a corporation, a corporate tax return, or an S Corp or partnership, but you fill out the IRS forms. Those are not financial statements being filed with the IRS. Those are, you have to prepare, like when you prepare your own personal tax return, that's not your financial statement. That is simply the tax return. It is a tax return prepared in accordance with IRS revenue code. So it's not, those are not financial statements. You do not submit a balance sheet to the IRS. You do not submit a statement of cash flows to the IRS. IRS doesn't care. They want you to provide the information they want. The information they want is based on law, and it's based on how much revenue they want to generate, the lawmakers, when they decide to make tax code. So you do not file financial statements with the IRS, you file tax returns with the IRS, which is actually a pretty big distinction, important distinction. Now part of the reason that this may look true is you say, well, I know so-and-so is a small business and they file their tax return with the bank when they go to get a loan. And that's sometimes true. If you have a very small company, the bank may say, give us your tax return in lieu of financial statements, because if you're really small, they'll be similar, very similar in the bank. Instead of requiring an audit, can say, well, let's see what you filed for taxes. But publicly traded companies submit their tax return, which are not their financial statements. Remember, we can use different methods of depreciation for our financial statements than our tax return, so we only file our tax return with the IRS, not financial statements. Another true-false one. Okay. An audit report is addressed to the board of directors and stockholders of the company. True or false? What do you have? You have 8 truths and 3 falses, and that I was expecting more people to get this right. This is true. When we do an audit report, we did on Thursday, we did a homework problem where we looked at an audit report, and it is addressed to the board of directors and stockholders of the company. In that audit report, it's always addressed to the board of directors and stockholders. Okay, next question is another true-false. We have a bunch of true-false today. Okay, it is the independent auditor's responsibility to determine whether the company's financial statements comply with generally accepted accounting principles. True or false? What do you think? True. What do you have online? A lot. 9 truths and counting. Okay. This is true. Now on this one, I want to make a note because I could also put this on the attendance quiz for today as it is not the independent auditor's responsibility. So do watch this one and other ones. Read carefully because I do know I have a couple questions where I flipped it. So do watch that carefully. Just don't look at the question and go, oh, that's true. Make sure, see what it's asking. Make sure it's not asking the opposite. So there's your heads up for today. I think this one very well could show up. I may have 2 versions of it, and one may be this one that's true, and then one could be false if it has a not in it. Okay, so the independent auditor, our public accounting firm, their responsibility, among other things, is to determine whether the company's financial statements apply with generally accepted accounting principles or international financial reporting standards. Okay, next one. We have another true-false. I think we have 2 more true-falses. Okay, the audit report. So this is the one written by the independent public accounting firm. The audit report is signed off by the corporation's management, confirming the audit was completed properly. True or false? I'm asking you now. What do you think? True? Okay. What do you think? False? Why do you say false? Because everyone else said true, right? Okay. What do you have? Okay. This is indeed, you're right to pick up on this one. This one is false. Okay, so let's talk about why this is false. The reason it's false is we talk about the audit report. The audit report is prepared by our independent third party, this public accounting firm, comes into the corporation, examines everything, and says, yeah, we think everything's presented fairly, etc. It would make no sense to have the corporation say, oh, it was conducted right or not, because then the corporation could say to the auditor, could say, well, we're not going to sign off unless you let us do this. You do not want corporation management to have anything to do with that audit report. That audit report is telling investors and creditors that this independent third party came in and examined things. Now, that's not to say in real life, if we have auditors come into our corporation and auditors check everything, and if they find an issue, it's not like they race to the audit report and write you up. If they find an issue, they first start talking to management and seeing what happened. A lot of times there's a legitimate reason for it to be like that, or it's an error and it can be corrected, and then it's corrected. So there is talking back and forth going on between the auditor and management. But ultimately, the auditor certifies, signs off on their audit report. Management does not. Okay. Okay, and then I think we have one more true-false question, then we'll get to some other types of questions. So the last true-false, and we talked about the topic of this next true-false on Thursday. So I want to see how many people answer this right or wrong. An unqualified opinion by independent auditors indicates the fairness of the company's financial statements and effectiveness of its internal controls. True or false? What do you have? Do you have a lot of answers, Brian?
Yes.
So you are exactly split. So now I guess I'm going to have to look here. Okay, I was asking over here, so I'll ask over here. What do you think? Put you on the spot. You're first.
False.
False. Okay. True. What do you think?
False.
False. So we have true, a bunch of falses. I always ask you, so I'm not asking you. What do you think? False? True? False. True. Okay. The answer, what are you still split? Pretty much? 10 falses, so it's searched ahead. The answer is actually true, and this is important to note. That word unqualified, is really important because unqualified means that the opinion is not qualified for any exception. So a qualification is considered to be except for. So if we had a report that said everything's fine except for the cash statement or something like that, that except for is known as a qualification. So an unqualified opinion means we don't have any except fors, and that's what we want. So an unqualified opinion is a clean opinion. An unqualified opinion is what you want. So this is a misnomer. It feels like it's, and they've done this for 30 or 40 years. They've been known as unqualified opinions. That term is going to go by the wayside in the next couple of years, but for now it still absolutely exists. So you need to know an unqualified opinion is clean. If you have a qualified opinion, that says that you have some issue that doesn't conform with generally accepted accounting principles, or internal controls are not adequate, or something's wrong. Okay, now we have a multiple choice question. Okay, so multiple choice, we're still in Chapter 11. By the way, we don't have that much left with 11. We are going to get into Chapter 12 today. So I'd say we have probably another 10 minutes in Chapter 11. Okay, which entity requires companies issuing publicly traded stock to have their financial statements audited by an external auditor? So who requires? We said in an earlier question that all publicly held companies are required to have their statements audited. What agency requires that? What answers do you have, Brian? So mostly you have a kind of an even split between A and B. Okay, the entity that requires, that makes all publicly held companies, so companies whose stock is offered to the public, the one that requires companies to have those audits is the SEC. This is Securities and Exchange Commission. It was created in 1933, 1934. There's a big act then. But the Securities and Exchange Commission is the one who requires publicly held companies to be audited. The Securities and Exchange Commission is what companies have to go through to issue stock, and they're the ones that oversee stock things. IRS has nothing to do with publicly held companies having audits. Do not equate IRS and audit. These are two different things. When the IRS audits a company or an individual, they are looking to see if the tax law was applied correctly on the tax return. They are not looking to see if the financial statements present fairly results, etc. An audit by a publicly traded stock has an audit. When we refer to the audit, we are referring to this independent third party, an auditor that comes in. Doesn't have anything to do with taxes. The IRS does have audits, but those are very, very narrowly focused, and they deal with applications to the tax code. An IRS audit doesn't have anything to do with financial statements audits. Brian, Rhonda just shared that info is on page 666, second paragraph under Learning Objective 6. Thank you, Rhonda. Okay, next in the, we have not a question. I have a couple. Brian looked at the notes for this morning. This is just kind of a funny story. He looked at the notes today and said, oh, we have all questions today. And I said, oh no, look at slide 21. This is slide 21. So this is our lecture in chapter 11. Okay, so correcting retained earnings. Retained earnings. Well, I'm going to wait while people write, and then I'll start adding things to this slide. Before we get to talking about this slide in particular, we want to make a note, if you don't know it already, retained earnings. Retained earnings is not cash. Retained earnings is a running total of a company's earnings to date. This is forever, from the beginning of time for that company. So from the time the company started, retained earnings is a running total of all its earnings, less its losses, less dividends that it's paid. So retained earnings is this cumulative total of earnings. You might want to type that. Cumulative total of income to date, less losses, less dividends issued. Common misconception is that retained earnings is cash. Retained earnings has absolutely nothing to do with cash. It's just a running total of income, less losses, less dividends issued. Now, since retained earnings is this running total of income, less losses, less dividends issued, if we have any error corrections, they get to impact retained earnings. Let's say we're doing the audit this year and they discover an error was made last year and it's too late to go back and fix it. What we do is we do something called a prior period adjustment. And this is where we have revenue or expense was recorded incorrectly in an earlier period. So let's say we're doing the audit, they're doing the audit this year, and it comes to light that 3 years ago there was an error in sales revenue. So we can't go back and fix 3 years ago because it's past. What we do is we do a prior period adjustment, and we correct the error, and the effect of the error goes to retained earnings. Retained earnings doesn't have too many journal entries to it. Retained earnings gets prior period adjustments. Retained earnings gets dividends. And retained earnings, this is going back to chapter 3, retained earnings also gets the closing entries. So that's how income goes into retained earnings. It gets closing entries. So retained earnings we typically don't put journal entries to, but the income ends up in there, the losses come out of there, and dividends issued come out in retained earnings. So that's retained earnings. That said, we have a few more questions and we'll be into chapter 12. Prior period adjustment that corrects income of a prior period requires an entry to what? Do you have lots of answers yet? What do you have? Okay, so predominantly, yes, the answer is C. Retained earnings is what we just said. So when we have a prior period adjustment, that is going to require an entry to retained earnings. We might be adjusting a liability account. We don't know. We might be adjusting an asset. We don't know, but we know a prior period adjustment has to affect retained earnings. Okay, and then we have one more question with Chapter 11, and then we'll move on to Chapter 12. And this has to do with these prior period adjustments. Basically, this next question is asking, do prior period adjustments increase or decrease retained earnings, or what? Do you have plenty of answers there? Okay, that's what I needed to hear. It is indeed C. We don't know which way the air will affect. We don't know which way this air will affect prior period adjustments. So it can increase retained earnings, it can decrease retained earnings. Now we put on our Chapter 12. So Chapter 11 was about the income statement and the statement of stockholders' equity. So now what we're going to see in Chapter 12 is we're going to see the second to the last chapter, and we are going to be talking about the last financial statement. So up to this point, the financial statements we've talked about. We talked about the balance sheet a lot. We see the income statement over and over. And then we saw the statement of stockholders' equity. Now in Chapter 12, it's about the fourth statement. And the fourth statement is the newest of all the statements. The other statements have been in existence for 100 years or more. The statement of cash flows is a relatively new statement. It came out, it started being required in the U.S. around 1987 or 1988, so it's a relative newcomer. And up to this point, before we had the statement of cash flows, we had the statement of changes in financial position, which was really kind of an odd statement, and most investors didn't find it useful at all. So they replaced it with a statement of cash flows. And as it turns out, the statement of cash flows is one of the most important statements, but we have to make it through the rest to kind of have an idea, hope of understanding it. More companies fail due to lack of cash than lack of income. If you don't have cash, you're not going to exist over the long run. So the statement of cash flows tells investors where the cash is coming from and where the cash is going to. And where a company gets its cash can say a lot to an investor. If I'm thinking of investing in a company and they're getting all their cash by doing new borrowing, but they're using cash for operating, that's not a good sign typically. Because operating means this is what you're in business for, this is your reason for being, and if you're not generating cash by that, there could be a problem. So what we see in this chapter is we see the purpose of the statement of cash flows. Purpose of statement of cash flows, we want to see the health of the company, we want to see where it's generating its cash and what it's using the cash flow for. We see in Learning Objective 2, there's three main types of cash flows. There's operating cash flows, which are why we're in business. If we're Amazon, our operating cash flows are going to be typically the sales of merchandise. That's why they're in business. Target, the sales of merchandise. Investing cash flows are things like investing in a new building. These are long-term assets. We're investing in long-term assets. We can also sell them off. When you see companies sell off store locations, they are generating cash from investing activities. And then we have financing activities, and financing activities are long-term debt and stockholders' equity. So financing activities involve taking out a loan, paying off a loan, issuing stock, buying back treasury stock. Those are all financing activities on the statement of cash flows. So as an investor, we look at this statement and we see where we're getting cash from and where it's going. And then finally, learning objective 3 is actually preparing a statement of cash flows using the indirect method. There are 2 methods to prepare the statement of cash flows. The first method is in learning objective 3. The indirect method is the easiest one to prepare. It's computationally. It's easy. It's easier in real life. It's the way our accounting systems have been designed to deliver information. It's the one that's most commonly used in the U.S. So we have statement of cash flows. Typically you're going to see a company prepare it using what's known as the indirect method. Learning objective 4 that we're not covering is statement of cash flows using the direct method. The direct method is the only acceptable method under international financial reporting standards, but our information systems are not set up in most cases to supply the information. The direct method provides a better statement for investors. It's easier to understand, but it's a lot harder to prepare. So we're kind of in this situation where we're preparing indirect. Ultimately, eventually, I think people are going to be companies are going to end up switching to direct, but it's not this year, anytime soon. So we have 3 learning objectives in this chapter. So direct method, just know it's another method out there, but we're not using it. So what am I going to do? I've got a couple questions. Okay, so a couple questions because I think these serve to highlight some information, and then we're going to talk about the actual statement and where we would find information on it. Okay, true-false questions. I think I have 2 questions, and then we're going to look at an exhibit. The statement of cash flows is an optional statement that can be prepared along with the income statement, balance sheet, and statement of retained earnings. True or false? This question is false. And the reason it's false, I have a couple things to say about this. The word optional and can be. The statement of cash flows is required. If you are required to issue financial statements, you are required to issue all 4 financial statements. You have the statement of cash flows, you have the income statement, the balance sheet, and the statement of retained earnings. Now, I want to, a couple notes that would be helpful to know. The last part of the sentence, the statement, refers to statement of retained earnings. Statement of retained earnings can also be interchanged with statement of stockholders' equity. So when you see the statement of retained earnings, most companies do not have a statement of retained earnings. We teach it in the book because it's manageable. The statement of stockholders' equity is pretty big, pretty lengthy, and gets pretty hairy to go through. So the statement of retained earnings is a subset of the statement of stockholders' equity. So if you see statement of retained earnings, yes, treat it as a financial statement, but in real life it might be the statement of stockholder, it probably is the statement of stockholders' equity, which includes the statement of retained earnings. Also to note, the income statement is also known as the statement of operations. Okay? So income statement is the common term, but a lot of times they will call it the statement of operations. Statement of operations is just another term for income statement. What we're doing next is we're going to look at a statement of cash flows. So I want to talk about a statement of cash flows. And this, you're not going to be able to see everything. I'm going to zoom in and out, but I wanted to have something to talk about. So this is page 702 in your textbook. This is Exhibit 12-3. And this is a template of a statement of cash flows. This is actually something pretty good to use. I don't know that I would put this whole thing on my reference sheet, but if you can write small and read it, it might be worth it. This is a template. This is the whole statement of cash flows. I don't know that I put it on there. I put some other rules that we'll talk about on Thursday on there, but this is certainly going to allow us to talk about the statement of cash flows. So given that we have page 702 in your textbook, now I know this is little, but I wanted a bird's eye view of what we're doing. So a statement starts with the name of the company. The second line down is the name of the statement, and the third line down is year ended. So note that a statement of cash flows is for a period. It's not for one date. The only financial statement that is for one date only is a balance sheet. Everything else is for the year ended. Okay, first section on the statement of cash flows. So what we're talking about now, what we're using this exhibit for, is to kind of look at the sections on the statement of cash flows. The first one is cash flows from operating activities. There are three sections on the statement of cash flows, three sets of activities. The first one listed is always going to be operating activities. And this section tells where the company got its cash. Did it get money from operating activities, or did it overall spend cash on operating activities? In a mature company that's been in existence for a while, you would want to see operating activities provide cash. So we have operating activities. That is the single biggest, most important category of cash flows, by the way, the operating cash flows. When an investor looks at a statement of cash flows, they want to see what's going on with operating activities. Operating activities are a company's reason to be. They support the mission of the company. If a company can't generate cash from its operating activities, you start to question it. Now, all of that is said thinking that sometimes in a startup mode, companies do not generate cash from operating activities, and that's fine. A lot of these startup technology companies bleed cash for the first few years, and that's to be expected. But if you have a healthy company that's been in existence, generally you're going to see cash generated by operating activities. Okay, next section on the statement of cash flows is the cash flows from investing activities. So we start with operating activities, we calculate those, and then our next one is cash flows from investing activities. So you have to know all three types of activities and what they include. So operating activities are what we're in business for. Investing activities typically focus on long-term assets. These are our property, plant, and equipment, long-term investments. So cash flows from investing activities are the second category. So we have operating, investing, and then our third category of cash flows is down below, and it's cash flows from financing activities. So financing activities are going to be your long-term debt, and it's also going to be your your payment, issuance of stock, payment of dividends, things like that. On a statement of cash flows, you have all three activities listed. They are listed in that order. Okay? You always have operating, you always have investing, and then you always have financing. Now at the bottom line of your statement of cash flows, what you see at the very bottom of the statement is you end up with the balance of cash on the balance sheet. So this one feeds back into the balance sheet. It will tie to it. And that bottom line, cash at December 31st, 2012. So basically what you're saying is, here's my end cash, and you're above this point you're showing where all the cash came from and where it all went. So it balances to the balance statement, the cash listed on the balance sheet. What we're going to do now is we're going to talk about specific sections on the statement. So I'm going to start. I'm staying on the same exhibit, so page 702 in your textbook, and we're starting with cash flows. We're going back to cash flows from operating activities. So that was a bird's eye view. Now we're going to look at the cash flows from operating activities. So what I'm doing next, what you're going to see, is everything that's below that in the operating activity section is going to appear on your screen and blown up in bigger type. So I'm just taking that section. So that's where I'm taking it from, is right below there. Okay, so we have some better way to read it. Okay, cash flows from operating activities. We're preparing our statement using the indirect method. So it will always, always, always start with net income. Net income is the starting point of this section. Operating activities are basically saying, how much cash did you get from being in business? Now our net income says, how much revenue did we generate? Revenue and cash are not the same thing because we are on an accrual basis. So what we do in this section is we start with our net income. Net income is on an accrual basis, and we need to make all these adjustments to adjust our net income to a cash basis net income. We're basically saying, okay, if we had used cash basis, how much income cash would we be showing as provided by operating? So what you see here is we start with net income, and then we have a list of adjustments. Now these adjustments, absolutely, this I would put on my sheet. This is a good thing to know. The adjustments to reconcile net income, these are in your book. They're very common, and this would be something I would make sure I listed somewhere. The very first adjustment you have is to add back depreciation, depletion, and amortization. And the reason we're adding that back is you figure these were subtracted in coming up with net income, so we want to adjust net income back to cash. Depreciation has no effect, it's a non-cash expense. And then we're adding back loss because we would have deducted it. That's also a non-cash item. We're subtracting gains because those are non-cash items. And then the rest, the increases in current assets other than cash, decreases in current assets. Notice we subtract increases, add decreases. After you do a statement of cash flows for a while, this all starts to make sense. I would be very surprised if it would make sense the first time or two through this for you. So what I would suggest doing is this exhibit, this part, where you have net income and then you have these adjustments where you add some things and subtract, I would write those on my sheet. There's no doubt in my mind I would put that on there because you'll see some questions on Thursday. We're going to go through some questions and you'll be able to answer several of the questions using this. Okay? So this particular adjustments to net income we will see over and over. Now, we're going to continue walking through. We've got the investing section coming up, and we have the financing sections coming up now. But what I need to do now is we're going to end class. So if you're online, we're done. Okay. If you want to stop recording. Okay, and if you're